Matt, why don't we start with you? Why don't you discuss why valuation is such an enforcement priority for regulators?
Of course. Excuse me. But first, I'd like to say I used to teach at GW, and my first day of class, this is like my first day of class, none of the students would sit in the front row. So, Victor, you're my prize pupil today. So, but okay. Anyway,
that's your A right there.
You get an A. It doesn't matter. All right. So, well, let's begin with the SEC's mission. And if you go to their website, you will see that it has three main priorities. One is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. So valuations affect all these elements of the SEC's mission. And many public companies and investment companies have significant assets on their books that are based on valuations. And those valuations many of those are at fair value, like Jesse mentioned. And those fair values are they're required to be measured when they're initially acquired, and then periodically after that, right? So an improper valuation in any asset will result in the company's financial statements to be misstated, or and causing its stock prices or NAVs, the net asset values of the investment company, to be misstated. So if any asset is overstated, which is arguably the worst of the two scenarios, right? Then investors can be harmed by overpaying or being lured in to an investment fund. Of course, that said, a company that undervalues its assets may hurt investors that sell out while the underlying company may be undervalued, and the stock price then may be correspondingly be undervalued. Accordingly, the valuation process is integral to maintaining confidence in our capital markets. So circling back to the SEC's mission, without a consistent and impartial valuation process, investors can be harmed and the capital formation process will be hindered. Accordingly, most of the assets require some periodic valuation to be performed. While I would like to think that a very high percentage of entities are trying to get it right, there are still a fair number of SEC cases that involve impropriety. So there are always a few bad eggs rooted for everybody, right? Valuing assets, which there's no readily available market, requires significant judgment. So who performs the valuation and how it is accomplished will be at the forefront of the regulators' minds. Now with that, there was a new commission that came in 2017, following changes in the executive branch of the election. And Jay Clayton became the chairman of the SEC. He announced a variety of initiatives, including a renewed focus on retail fraud, which is an effort to protect Main Street investors versus Wall Street investors. This followed actions by the SEC in 2016, and they reassigned 100 staff to the investment advisory examination unit. And those are the people who go out to and inspect and examine investment advisors and investment companies. This initiation puts a spotlight on investment advisors, hedge funds, and private equity and the like, including how the respective investments are valued. So you might see a lot more activity in that space than we have seen some more.
Sure. So, I mean, one thing I wanted to add on this, I mean, investor protection, I think when the SEC talks about its three missions, it often focuses immediately on investor protection versus the other two. And I think one of the reasons why valuation is a recurring theme of the Division of Investment Management in particular is because it actually is one of the few areas in terms of investor protection where there's significant discretion exercised by the participants in the market, namely the advisors and the funds that they manage. And so, you know, what we often hear when we're talking to the SEC, not so much the enforcement division because they tend not to talk, but the examination branch, which comes in and actively explores the activities of market participants on a regular basis. And they focus on this element of discretion. And I think that's where you see, particularly with alternative investments, where there often aren't liquid markets for some of the assets that are being acquired, you know, this focus on trying to police the exercise of ad hoc determinations and discretion is really, I think, why we see this recurring approach and focus on valuation. The other area where the SEC focuses, and a lot of you will be aware of this, is on the determination of fees by the board. And the board is mandated by the Investment Company Act and the Advisors Act to monitor and police fee levels. And again, if you think about it, this is not a market-determined exercise. There is somewhat of a nascent market evolving in terms of management fees and incentive fees that apply to different types of fund entities. But generally speaking, it's done on an ad hoc basis by different boards of directors and advisors. And so again, that becomes a focus of the regulators because they recognize that when fraud occurs, it often occurs in shadows and in places where there isn't sunlight. And these sorts of valuation determinations are kind of, not that they are, but they certainly have the potential to be an area of fraud. With that, I guess I should turn a little bit to, in addition to why this is a focus of the SEC, what are the ramifications? And we talked a little bit about the fact that you can end up with improper trading signals in the market. So obviously that's a significant element of focus for the SEC, but also the payment of fees, determination of fees, and because the inputs are typically based on assets and the income or capital gains generated by those assets, that becomes an area of focus because if the inputs are flawed, then the market can't correct and appropriately value. And so the SEC, through a number of different avenues, tries to police that, and the PCAOB, under delegated authority from the SEC, works with the audit firms to put in place appropriate regulations to, police the activity of the monitors, in effect. That's the PCAOB's action. Just to quickly, and we'll spend a little bit more time on this later, what are the ramifications of doing things wrong? There are a number of statutes that come into play, and they'll be discussed this morning. Section 10b-5 in the 34 Act, or the Securities Exchange Act, excuse me, is a regulation that basically requires that any disclosure related to the operation of an investment fund or a regular operating company has no material misstatements or omissions. And so there's a feedback loop here from the determination of valuation and how that plays through the public disclosures, whether it's in the financial statements or the actual amounts that are being disclosed, or the discussion of the process that's being undertaken by people. So that's 10b-5. And then there's also Section 38A1, and I don't want to make this just a legal seminar, but that's basically the item that says that advisors who work with funds have to develop policies and procedures that are appropriately designed to ensure that there'll be compliance with the securities laws, and in particular the Investment Company Act. So those are kind of the two areas. There's also some other provisions in the Advisors Act that come into play about conducting your operations fairly and without committing fraud. But I think the two that we hear most often from the examination branch are 10b-5 and 38A1.
And as I mentioned in my opening, a lot of times a lot of investments are very easy to value, but other types of investments require a lot of estimates and the application of certain accounting guidance.